Welcome, dear traders. The last months and the whole quarter were quite challenging for Wall Street. At the beginning of the new trading week, new months and quarter, futures on the US stocks showed a rise. Traders opened a new long period on a positive note. However, an increase in bond yields stopped the rally. At present, it's quite difficult to predict a trend as the traders are recovering after tough months when the S&P 500 manifested the worst performance in a year by slumping by 4.9%. Meanwhile, the 10-year bond yield jumped to the highest level seen in 2007. The situation could be explained by concerns caused by strong inflationary pressure that could force the Fed to keep the key interest rate at high levels. On a Monday, news that Washington managed to prevent a government shutdown, which could have become extremely damaging for the US economy, somehow supported the market. However, this was a short-lived effect. The monetary policy issue and expectations of a UK rate hike are still of a crucial importance and are keeping interest in risky assets. In general, investors are likely to show interest in assets this week amid a quite high consumer activity and the healthy economic situation in the United States. This should boost corporate income in the near quarters. In this case, stocks will also have chances to gain in value. Let us find out what will happen this week. Stay tuned, watch the video up to the end and share your opinion in the comments. This week, traders are likely to switch to the next auctions of the Federal Reserve and digest the recent data, including the labor market report issued on a Friday. A forecast for stably high interest rates remains unchanged. Michelle Bowman once again called for another hike, while John Williams suggested on a Friday that interest rates should remain high for some time. Assumptions that the key interest rate will remain high for a longer period of time and the growth in the bond yields continue to exert pressure on the stock market. Thus, the 10-year bond yield is at its 16-year high, whereas the yield of short-term bonds also increased. In particular, the yield on a 2-year bond is 5.1% and the one of a 5-year bond exceeded 4.6%. On a Monday, the Dow Jones lost more than 200 points. The S&P 500 dropped by more than 0.5% and the Nasdaq added 0.4%. Traders priced in the better-than-expected data on the ISM manufacturing PMI. According to the report, a decline in the indicator stopped and the price pressure weakened. The yield curve is likely to shape market sentiment this week. Nevertheless, traders should also monitor macroeconomic indicators. According to the forecast, the unemployment rate will stay at 3.8% in September. The number of employed people in the non-farm sector may decline to 150,000 from 187,000 in August. The 3 months average totaled 150,000. If the difference between available jobs and the number of unemployed continues to decline, this will indicate a stabilization in the labor market. In this case, the Federal Reserve may stop increasing rates. Powell's words will be of primary importance. At the same time, they will hardly differ greatly from his statements at the meeting just a couple of weeks ago. The US economy is still coping with the challenges of recent years, Powell said during a meeting with the community and business leaders in New York, Pennsylvania. He highlighted a shortage of labor in the healthcare sector and other problems. Powell did not comment on the current monetary policy or economic prospects in his brief opening remarks. As for indexes, the Dow Jones showed a quarterly drop of 2.6%. In September, its dynamic was not impressive. In general, September once again proved to be a difficult month for the US stock market. All the indexes slumped, manifesting an accurate correction. Notably, industrial companies suffered the smallest losses. The shares dropped by just 3.5%. At the same time, companies with smaller capitalizations lost 6%. It means that traders prefer more stable companies to fast-growing and risky startups. Taking into account the season, the expected trends are likely to be positive. October and November are the most successful months for the American stock market. It means that Santa Claus rally is likely to take place this year. And will the market rise amid an uptrend, violation and a recession? There are two scenarios. The first one suggests quite a gloomy situation when the market may launch a correction after a noticeable upward movement. In this case, the market will tumble. The second scenario is more optimistic. The market showed an insignificant correction by losing 5 and 6%. The market depth remains small, and the US dollar index is at its peak, whereas seasonal trends suggest a rosy future for the market. According to this variant, at present, the market is at a point that will allow it to rise in the future. The probability of the second scenario seems to be higher and is estimated at about 80%. The degree of anxiety in the market is excessive now. What's more, the market has no grounds for further decline. Of course, this does not mean that assets will skyrocket tomorrow. In general, this is a good time to choose the assets of the companies you are interested in. The S&P 500 declined by 4.9% in September, having the worst month in 2023. During the quarter, the index slid by 3.7%. Let us find out what to rely on at the moment. The S&P 500 seemed to be touching support and resistance levels. A breakout and consolidation above 4,330 points will allow the asset to climb to the key resistance level of 4,450 points, and this is a very important level, as its previous breakout seen in September after the Fed's meeting nullified the bullish scenario and pushed the asset to 4,600 points. After that, bears became active and saw their targets at 4,300 and 4,200 points. From a technical point of view, consolidation above 4,330 points may encourage traders and boost the index to 4,450 points. If it fails to break this level and settles above it, traders may resume selling, thus pushing the index to the previous support area of 4,300 and 4,200 points. Investors should monitor the index near these key levels and price in macroeconomic news, the Fed's decision, and other factors that may influence the market. During the given period, the Nasdaq decreased by 4.1%. However, a rise recorded on a Monday, especially in the shares of developing companies, points to mounting optimism among investors concerning the tech sector and innovations. Stocks of Nvidia jumped by 2.8% just after Goldman Sachs added the shares of the chip manufacturer to its conviction list. Tesla shares rose 0.5% after declining by 3% earlier in the session. as the company fell short of market estimates for third quarter shipments. As for other large companies such as Apple, Meta, Amazon, Alphabet, and Microsoft, the growth of their shares could be explained by the general decision to perceive these companies as safe havens in conditions of economic instability, and these companies have strong financial indicators and diversified businesses which can attract investors looking for stability in a period of uncertainty. Positive news from the US manufacturing industry could also contribute to the growth of stocks. The acceleration of production and the recovery of employment are positive signs for the economy as a whole. This may strengthen investor confidence in the stock market. In general, this news can be considered positive for the market, and we continue to monitor the market situation to keep you abreast of the recent events. Subscribe to our channel and comment on the videos. We are working for you, preparing the most relevant reviews every day and every week, and this is all for now. See you soon.